Let's discuss how a promissory note and a mortgage or trust deed all relate together in financing. The idea is, how does one go about obtaining a real estate loan? To buy a house, for example. The borrower has to sign what is called a promissory note. The promissory note is what creates the debt. Once the note is in place, which is the promise to pay, the lender wants the borrower to sign a second document called a mortgage or a trust deed. It depends upon what state you are in, whether your state uses a mortgage or trust deed. Both terms mean the same thing, however, security for the debt, or another term for that is the word collateral. With a mortgage state, the two terms involved will be the mortgagor, which is the borrower, and the mortgagee, which is the lender. Since the term mortgagor ends in OR, that means that is the giver, or givor if you will, of the mortgage document. So the borrower is called the mortgagor. Likewise, the word mortgagee ends in the letters EE, which once again is the receiver. So since the lender receives the mortgage document, the lender is referred to as the mortgagee. And in a mortgage state, we have judicial foreclosure, which means if the payments are not made, the lender has to go to court to foreclose. Let's contrast a mortgage state with a trust deed state. With the deed of trust or trust deed, which once again is the security for the debt, we simply have different terms for the parties involved. The lender is called a beneficiary. The borrower is called a trustor, once again the givor, if you will, of the trust deed document. And then we have a, quote, neutral third party who is called the trustee, who is the receiver of the trust deed document. That trustee typically is like an attorney for the lending institution. The purpose of the trustee is to foreclose if necessary. In a trust deed state, we have non-judicial foreclosure, which means that the lender, or in essence the trustee, does not have to go to court to foreclose. Even if a person is foreclosed upon, most states have redemption laws. Redemption means to redeem or buy back. Let's contrast equitable versus statutory redemption. Equitable redemption is the right of a borrower to redeem the property before the foreclosure sale, whereas statutory redemption is the right of a defaulting borrower to redeem the property after the foreclosure sale. In any event, when the borrower redeems the property, the borrower has to redeem for whatever the property sold for at the foreclosure sale, plus any other cost involved. If the property that is being foreclosed upon does not bring enough in money at the actual foreclosure sale, the borrower still might owe some money to a lender. Let's say that the loan amount on a first mortgage was $200,000, yet at the foreclosure sale, it only sold for $190,000. Therefore, the lender would still be $10,000 short. The lender many times can still go after the borrower with a deficiency judgment for that $10,000 difference. And finally, in a foreclosure sale, please remember that real estate taxes always get paid off first at a foreclosure sale. After that, it's any lien in order of priority based on the recording date. And finally, if there's any money left over at the very end, the defaulting borrower would get whatever was left over. The promissory note that a borrower signs to create the debt is always negotiable. And by negotiable, we mean that that note can be bought and sold. Many times when a loan is made and the borrower signs the note, the lender will sell or transfer that note to another lending institution. Your real estate payments that you make on your loan are always paid in arrears meaning at the end. Interest is also paid in arrears. What that means is that if a borrower makes a March 1st mortgage payment, that March 1st mortgage payment actually is paying the previous month's interest, that is, the month of February, because interest and payments are always paid in arrears. Finally, debt service is a fancy term that means your monthly mortgage payments are being applied to both principal and interest. That's what it takes to service the debt. Once the borrower has signed the promissory note, which creates the debt, then the borrower has to pay off the money that was promised to be paid. There are several ways that the borrower can pay off the money that was borrowed. One type of note is called a straight note or a term loan. Those two terms mean the same thing, straight note or term loan, and that's where the borrower pays interest only. This is typical on a short-term construction loan that may be only in effect for, say, 6 months. Another type of payment plan is called a partially amortized note. Amortized means the payments are going toward both principal and interest, principal being the loan balance or the loan amount. But with a partially amortized note, the borrower partially pays down the loan over the term, leaving a balance still left over at the end of the loan term. That balance is then paid off with what is called a balloon payment. A balloon payment is the final payment that fully pays off the loan balance in full. A third type of payment plan is called a fully amortized note. Fully amortized is what most of us think about with a typical 30-year home loan. Fully amortized means that the payments are applied to principal and interest, and the loan is totally paid off over the term. So at the end of the 30 years, the borrower owes the home free and clear. Another type of note is called a graduated payment note. Although not used too often today, a graduated payment note is where the payments are lower initially with the loan, and then they graduate or go up every year, typically for 5 years in a row. After 5 years, the payments will then level off. Finally, let's talk about an adjustable rate mortgage. An adjustable rate mortgage is a type of payment plan where the interest rate can change typically each year based on certain economic indexes. So with an adjustable rate mortgage, the interest rates can change, the payments can change, all things can change with an adjustable rate mortgage. One final thing to remember here, if a borrower wants to pay off the loan quicker and not pay as much interest, the borrower many times can make extra payments toward principal, which will reduce the loan balance quicker and reduce the total number of payments that will have to be made over the term of the loan. Let's talk about the provisions of a mortgage or a trust deed. Recall that a mortgage or trust deed is simply security for the debt. There are typically several clauses that can be included in a mortgage or trust deed. One is called the prepayment penalty clause. Some states allow these, some states don't, but the prepayment penalty clause is where the lender charges the borrower a penalty for paying off the loan early. Another clause is the acceleration clause. Acceleration means speed up. This is when a lender calls the loan due and payable upon non-payment. So if a borrower misses 2 or 3 payments in a row, then the lender accelerates the note, calls the whole loan balance due and payable, and then proceeds with a foreclosure sale. Another clause is the alienation clause, which is also called the due on sale clause. Those two terms mean the exact same thing. The alienation or due on sale clause is where the lender calls the loan balance due and payable upon selling or transferring the property, thereby making the loan non-assumable. So if a seller sells the property, the lender would call that seller's loan due and payable, and the buyer would have to obtain their own brand new loan. A subordination clause is where a first and second mortgage will switch places. In other words, the first becomes the second becomes the first. Subordination means to take a lesser position. So someone in the first position would agree to subordinate and become a second lien holder. Another clause is called the defeasance clause. This is the null and void clause. What this clause does is it voids the security once the loan is paid off. A way to recall that for the test is that the word defeat and defeasance sound similar. So if a borrower completely pays off the home loan and the lender never ever got a chance to foreclose, then the borrower had defeated the lender. So when you defeat the lender, that is the defeasance clause, which voids the security. Another clause is the escalator clause, which allows the lender to raise the interest rate on a particular loan. This will probably be used with an adjustable rate mortgage. Those are some various clauses you can find in a mortgage or a trust deed. A couple of other terms to note would be what's called a subject to versus an assumption. Let's say a seller sells a property to a buyer and the buyer wants to take over on the seller's loan. One way to do that is on a subject to basis, which means the buyer takes over payments only, while the seller remains solely liable on the debt. You don't see this a whole lot today. More common is a loan assumption. With an assumption of a loan, the buyer not only takes over the payments but also primary liability for the debt, but the seller still remains secondarily liable on the debt, so both parties will be liable. Many times a seller will try to get a release of liability from the lender, making the buyer solely liable. If the lender is willing to do this, we call this a novation, which means we have a new contract that takes the place of the old contract. There are many different types of mortgages and trust deeds that lenders and borrowers can use. Let's first discuss what is called a first mortgage. A first mortgage simply means that lender was the first to record, thus making it the first. Likewise, the second mortgage is simply the second lender that records. Another type of mortgage is called a purchase money mortgage. For the purposes for our exam, whenever you see the term purchase money mortgage, think of the words owner financing. This is typically where a seller is going to help finance part of the real estate loan on behalf of the buyer. That is called, again, a purchase money mortgage. A blanket mortgage is simply a mortgage that covers more than one piece of property. Just envision a blanket that floats down from the heavens and lands on more than one property. This would typically be used in maybe a development in a subdivision for lots of houses being built. The houses in a subdivision will be sold off one at a time, however, so normally with a blanket mortgage, you will have what is called a partial release clause that allows each property to be released from the blanket mortgage as sold. A package mortgage simply uses real and personal property as security. So if a house and a car were both used as security for a loan, we would call that a package mortgage. Another type of mortgage is called an open-end mortgage, which is similar to a line of credit. Think of a credit card example with revolving credit. With an open-end mortgage, a person can borrow again and again on the same loan. A home equity loan might be a type here. A growing equity mortgage is where the borrower makes extra payments toward principal, thereby paying off the loan quicker and thus growing equity quicker as well. And finally, a reverse annuity mortgage is where the lender pays the borrower each and every month a fixed amount of money. Since this is the reverse of normal, it is called a reverse annuity mortgage. This is used for senior citizens or retired folks who typically have their home paid off but need money to help them live in their retirement years. So those folks can many times take out a reverse annuity mortgage. Let's discuss 3 different types of loans borrowers can typically take out, especially when buying a home. The first type of loan is called a conventional loan, whereby normally the lender will loan 80% of the total value. We call that a loan-to-value ratio loan. So if a borrower buys a property for $100,000 and puts 20% down, which is $20,000, the loan would be $80,000. That is the loan-to-value ratio loan. On conventional loans, a borrower can put down less than 20% many times. We'll discuss that in just one moment. With conventional financing, keep in mind, there is no government intervention involved. This is simply money loaned by the private lender. Another type of loan is called an FHA loan, which stands for the Federal Housing Administration. FHA is really an insurance company run by the government. With FHA loans, the government insures the local lender in making the loan. Another type of loan, and the third type, is called the Department of Veterans Administration loan, or DVA loans. These are loans for veterans who serve in the military. Also, a non-married widow of a veteran can also apply for a veteran's loan. With a DVA loan, this is the only type of loan whereby the borrower can purchase a property with no money down. The lender will make a 100% loan-to-value ratio loan. Let's talk about these different types of loans as far as who can obtain them. Please remember that with a Department of Veterans Administration loan, or the DVA loan, the veterans will receive what is called a Certificate of Eligibility, which shows what they are eligible for. As far as the government support is concerned, with an FHA loan, FHA again is an insurance company run by the government, and who basically oversees the FHA loans will be HUD, H-U-D, which stands for the Department of Housing and Urban Development. If a borrower takes out an FHA loan, the borrower will have to pay the insurance, which is called MIP, which stands for Mortgage Insurance Premium. This insurance is paid over the entire life of the loan, as almost all borrowers will finance the MIP insurance into the entire loan. FHA again insures loans on behalf of the lender. Whereas the Department of Veterans Administration loans, the VA actually guarantees a certain dollar amount to the local lender. So keep in mind, FHA insures, VA guarantees. As far as the type of property, let's concentrate once again on the FHA and the DVA loans. The loans here will only be on a 1 to 4plex, but it must be owner occupied. So the borrower must live in one of the properties. So the veteran could buy a duplex with a DVA loan, but the veteran would have to live in half the duplex and then could rent out the other half. That would be allowed. As far as the dollar amounts are concerned, with DVA loans, please remember that veterans can use their eligibility more than once. It is not a once-in-a-lifetime loan that they can obtain. However, the veterans cannot reuse the eligibility until their previous VA loan has been paid off in full. As far as conventional financing is concerned, with the down payment especially, if a borrower wants to put less than 20% down, it is a riskier loan to the lender, so the lender requires insurance on this type of loan as well. The insurance for conventional financing is called PMI, which stands for Private Mortgage Insurance. Sometimes on a mortgage, a lender will charge the borrower discount points. Discount points are simply charged so the borrower can receive a lower interest rate than normal. If a borrower chooses to pay the discount points are always based on the loan amount, not the sale price. Also remember that a point equals 1%. So if a lender charges 1 point, that's 1%. If a lender charges 2 points, that's 2%. And the percentage is always based upon the loan amount. Some lenders also charge what is called a loan origination fee. These are simply the cost involved in initiating the loan, paying for the loan processor, and all the folks who put together the entire loan commitment. And finally, a lock-in commitment is where a lender will lock a borrower in on two specific things, and that is the interest rate and the discount points. So if a borrower applies for a loan with a lender may lock the borrower in, let's say for 2 months, at a 4% interest rate with 1 discount point. That will be locked in no matter what happens in the next 2-month time frame. What happens when a buyer walks into a real estate agent's office and says, "I'd like to buy a house, but I have no job and no money"? At that point, regular financing won't work for us, so we have to look at some alternative financing, one of which is where we have seller financing only. That is, there will be no regular lender involved. We call this document either a contract for deed, an installment contract, or a land contract. Any 3 terms mean the same thing, which is owner financing. The terms involved are as follows. The seller is called a vendor, which is the seller, or the givor, whereas the buyer is called the vendee, or the receiver. When a contract is signed on a contract for deed, let's assume it's a 10-year contract for deed. The buyer will make payments to the seller over the entire 10 years. During that entire time frame, the seller or vendor retains the legal title because the seller keeps the deed the entire time that the payments are being made. Likewise, the vendee or buyer, at the time of the signing of the contract, receives what is called an equitable title or equitable interest. Equitable title simply means that the buyer has the right to get the deed later on after the entire payments have been made. So let's assume that over 10 years the buyer makes all the payments to the seller. The seller then, after 10 years, will finally give the deed to the property to the buyer. The buyer will then have legal title. So equitable title is what is conveyed through a contract. whereas legal title is what is conveyed through a deed. The primary mortgage market is where loans are actually made between the lender and the borrower. Several lenders can be involved in the primary mortgage market. They are as follows. Number one are your savings and loans. Savings and loans typically make residential home loans. Number two would be commercial banks. Commercial banks can make all types of loans, but they tend to specialize in making business loans. And number three would be your mortgage bankers. Mortgage bankers typically lend other people's money, but it's a good place to go possibly to obtain a home loan, something that a borrower should check out. One final note. Let's talk about who a mortgage broker is. The term broker literally means that we're bringing two different parties together. So a mortgage broker is simply someone who finds someone who wants to loan money and matches them up with someone who wants to borrow money and gets paid a fee for the service. The mortgage broker is not actually a lender, but they have access to lenders with lots of different types of financing available. So a mortgage broker has a wide variety of mortgage options available to show potential borrowers. The secondary mortgage market is where loans that have already been made are then resold. There are three organizations in the secondary mortgage market. The first one is called the Federal National Mortgage Association, or FNMA, or Fannie Mae. Fannie Mae is the largest organization in the secondary market, and Fannie Mae buys all types of notes from local lenders. Fannie Mae is actually a private company for profit, but is government-sponsored and is under the supervision of the government. So they're kind of quasi-governmental, if you will. A second organization in the secondary mortgage market is the Government National Mortgage Association, or GNMA, or who we call Ginnie Mae. This is strictly a government corporation. Since Ginnie Mae is a government corporation, they tend to buy government loans, such as FHA and VA loans. The third organization is the Federal Home Loan Mortgage Corporation, or who we call Freddie Mac. Freddie Mac is also a private company, like Fannie Mae. Freddie Mac tends to specialize in buying conventional notes from savings and loans. There are four different laws that deal with financing legislation. The first one are called usury laws. Usury laws set the maximum interest rates that lenders can charge by law. It keeps lenders from basically charging excessive rates of interest. The second financing legislation law is called the Truth in Lending Act. The initials are TILA, or this is also referred to as Regulation Z. This law is primarily about disclosing loan costs to potential borrowers. It applies to residential home loans. The law does not, however, apply to commercial or business loans. The law says that when a borrower goes in to apply for a loan, that the lender must tell the borrower the annual percentage rate, or APR. The APR is basically the total of all the loan costs expressed as a percentage. Truth in Lending also deals with the right of rescission on a borrower's home loan. The right of rescission is a 3-day right to back out of a loan commitment. Note the right of rescission does not apply to brand new first mortgages, but it does apply to second mortgages, refinances, those type of loans. Truth in Lending also applies to advertising requirements. We have what are called trigger terms, which are specific loan terms, such as the interest rate, the number of payments due, the mortgage payment, etc. If any trigger term is in the advertisement, then a required list of all disclosure of loan terms must also be in the advertisement, including again the APR, the number of payments, the financing totals. All those items must also be included. In other words, it eliminates lenders from advertising only one specific term. If you look at the whole package, the whole deal is not so great after all. It's to eliminate bait advertising. A third financing legislation law is called the Real Estate Settlement Procedures Act. The initials are RSPA, or this is who we refer to as RESPA. The whole purpose of RESPA is for disclosure of the total closing cost. Whereas Truth in Lending or Regulation Z was about disclosure of loan cost only, RESPA deals with the total closing cost, things like the surveys, the inspections, all of the closing cost. The main idea is as follows. A borrower within 3 business days of a loan application is given what is called a home loan toolkit. This is a booklet that explains all of the closing cost. Also within 3 days of a loan application, the borrower must be given what's called a loan estimate. This is again coming from the lender, and this is an estimate of what all of the total closing costs will be. Finally, there is what is called a closing disclosure, and this must be given to the borrower no later than 3 business days before closing. The closing disclosure will list all of the actual final closing costs for both the seller and the buyer. Finally, RESPA also prohibits kickbacks, which means that there can be no referral fees involved in the closing process. In other words, a lender cannot kick back $200 to a real estate broker for referring all of those brokers' buyers to that lender. That would be illegal. The final financing legislation law is called the Equal Credit Opportunity Act, which is basically fair housing for lenders. It says lenders cannot discriminate based on race and color and religion, those type of items, and also lenders cannot discriminate based on age or marital status.